Welcome to the Deep Dive, your shortcut to getting informed. Today, we're jumping into Pure Cycle Corporation, that's ticker PCYO.
Right.
We're looking at their third quarter fiscal year 2025 earnings call.
And on the surface, it looked like maybe a slight miss, right? The market reaction wasn't huge, but there was a reaction.
Exactly. A bit of a shrug, you might say. But that's why we're digging in. Pure Cycle isn't your average company.
No, definitely not. They're this unique mix of vertically integrated Colorado water utility and a land developer.
A real unicorn, as they sometimes get called. And there's potentially billions in sort of hidden value there, especially with water being so critical out west.
Absolutely. So let's unpack why this quarter, even with that slight dip in the numbers, might actually point towards a really significant long-term picture.
So you mentioned the market reaction. What did that look like specifically?
Well, it was pretty mild, actually. The stock dipped about 2.3% the next day.
Okay.
Trading volume was up, 20% above average, so people were paying attention. But it wasn't panic selling. And importantly, other water utility stocks didn't really move much. They were kind of flat.
So the market seemed to view it as a pure cycle-specific thing, not a broader sector issue.
Exactly. Seems like it was pinned on their results specifically.
Okay, let's get to those results then. Q3 FY25. What were the key numbers?
So revenue landed at $5.1 million. The expectation was closer to $5.2 million, so a near miss there.
In earnings per share?
EPS came in at $0.09, 9 cents. The whisper number was maybe 10 cents. So again, slightly under.
On paper, yeah, looks like a miss. But what else is going on beneath that surface?
Well, this is where it gets interesting. The underlying strength was pretty impressive. They reported a gross margin of 63%.
63%? That's really strong.
It is. And there was another key factor. They had $1.1 million in mineral royalty income.
From their mineral estate.
Exactly. And that provided a real cushion. It shows they've got diversified income streams, which isn't typical for just a land developer.
That 63% margin is definitely eye-catching. It translates to, $3.2 million in gross profit for the quarter.
Yeah, that's right.
But if margins were that good, why did the revenue number dip quarter over quarter? Was there a demand problem?
No, not really a demand issue. It was mostly about timing. Specifically, timing related to lot deliveries in what they call Filing 6 at their Sky Ranch development.
Filing 6. Okay.
Yeah.
What's different about that?
Well, DR Horton, the home builder, has almost double the usual number of lots in that specific filing. It's a bigger, more concentrated phase.
Okay.
And revenue recognition for these lots happens when they're physically completed and handed over, so it's weighted differently this time.
So just to clarify, it's not that builders don't want the lots, it's just the accounting, the recognition of the revenue is shifted because of how this specific phase is structured.
Precisely. It's a timing thing.
Yep.
And the company was pretty clear they're still on schedule to deliver everything by their fiscal year end, which is August 31st.
Did the CEO confirm the full year outlook then?
Yes, CEO Mark Harding reaffirmed it. They're still guiding for full year revenue of $30 to $31 million.
Okay.
And gross profit guidance around $23.7 million. They expect to wrap up the work on those Filing 6 lots, about 220 of them, by late July or early August.
So the revenue gets booked in Q4. It's deferred, not lost.
Exactly. That's the key takeaway on the revenue side.
Okay, let's pivot to their operations. The water utility segment, that's a huge part of their unique story.
Yeah.
How does that side of the business actually make money?
Right. The water side. It's got 3 main revenue streams. First, you've got annual customer growth, just more homes connecting each year.
Makes sense.
Second, industrial customers. Think oil and gas, primarily. Now, they did signal that this might be a bit lighter in fiscal 25.
Oh. Why that?
Permitting delays for some new wells they want to put in at Lowry Ranch, but they expect that to get back to normal, maybe even grow in fiscal 26.
Okay, so a temporary dip expected there. What's the third stream?
TAP fees. These are the connection fees that homeowners, or rather builders on behalf of homeowners, pay when a new home connects to the system. And those have been strong, driven by deliveries in Filing 5.
And the value of the underlying assets here is pretty significant, right?
Yeah.
The call mentioned $65 million in water assets.
Yeah, that's a big number. And it really represents the core long-term value. If you break it down, about $32 million is in the water rights themselves.
Which are like gold in Colorado.
Exactly. Scarce, valuable, essential. Then you've got $24 million tied up in the actual water and wastewater systems they've built.
Infrastructure.
Right. And another $9 million specifically in wastewater systems. But it's not just static value, it's about the capacity this enables.
And that capacity is huge. They mentioned being able to serve up to 60,000 single-family equivalents.
And they're nowhere near that yet. They're really just, getting started tapping into that potential.
And each connection comes with that tap fee, which you said was significant.
Yeah, around $40,000 per connection.
Wow. So if you multiply that out by 60,000 connections.
You're looking at potential connection revenue of like $2.3 to $2.4 billion.
Billion, with a B.
Yeah. It's a staggering long-term figure. It really frames the scale here.
And it underlines the value of just owning that water in the first place.
Absolutely. Especially in the West. And it's worth mentioning their system at Sky Ranch is designed for 100% water reuse for irrigation through a dual distribution system. So good stewardship of the resource, too.
Yeah, good to hear. They also mentioned a new development starting up at Lowry Ranch.
Yeah, on a half-section parcel there. It just highlights their strategic land position. They're east of Denver, which is really the main direction the metro area can expand.
Because you've got mountains to the west.
Right, so their location is key for future growth.
Okay, let's talk land development then. How do they approach this differently? What makes them a unicorn here?
It's their model. They call it cradle-to-grave horizontal development, meaning they do everything to prepare the raw land for vertical building. Utilities, roads, curbs, gutters, the whole setup. Most developers don't handle all of that themselves.
They usually subcontract that out or rely on municipalities?
Often, yeah. So PureCycle doing it all makes them very attractive to home builders, especially the big public ones.
Why, especially the public builders?
Because PureCycle uses a just-in-time delivery model. Builders only take ownership of and pay for the finished lots right when they're ready to start building houses on them.
So the builders don't have to carry the land inventory risk for a long period.
Exactly. It minimizes their risk, which is huge for public builders who answer to shareholders quarter by quarter.
That flexibility sounds like a major edge. How's it playing out at Sky Ranch currently? Are the phases progressing?
Yep, the updates sounded positive. Phase 2C lots are apparently almost ready for delivery.
Okay.
And work is underway on Phase 2D earthwork, utilities, roads, all that, expected to go in this fall.
And they can handle different builders' needs, like some needing lots fast, others managing existing inventory.
Seems so. They highlighted that flexibility, bringing in new builders who want quick delivery, but also working with existing builders who might be pacing themselves a bit more.
And didn't they just break ground on a high school? That sounds like a big deal for the community.
Yeah, huge draw for families. It'll make Sky Ranch a full K-12 campus within the community itself by the 2026-2027 school year.
That definitely adds value. Looking long-term at Sky Ranch, they're still pretty early in the build-out, right?
Oh, yeah, very early. Only about 22% of the planned residential development is done.
Wow.
And none of the commercial development, the planned 2 million square feet of it, has even started yet.
So tons of runway left just within Sky Ranch.
Tons. They estimate something like $620 million in potential income just from the current zoning there. And that's before considering their other land holdings, like Lowry Ranch.
Okay, let's touch on another angle. Single-family rentals. SFRs. They're building some homes to rent out themselves.
That's right. And it's potentially a very high margin play for them.
Why high margin?
Because they essentially get to keep the equity value they create through the land development and water connection. They mentioned that value could be up to $150,000 per lot before even building the house.
So they capture that value instead of selling it to a builder.
Exactly.
Yeah.
They build the home on top of that embedded value and then rent it out.
Makes sense. But growth there has been slow, right? What was the issue?
Yeah, slower than they initially hoped. The main culprit was permitting delays, specifically related to new electrical standards in Rappow County, where Sky Ranch is located.
Regulatory hurdles.
Right. What used to be maybe a 2-week permit process stretched out to like 6 months in some cases.
Ouch. So does that logjam clear up? What's the outlook for SFRs now?
They seem optimistic. They're forecasting a strong acceleration in SFR units over the next 18 months or so.
Okay.
The plan is to get to around 100 rental units after Phase 2 is built out. It sounds like those permitting issues are starting to resolve.
Good. Shifting back to the overall company health, liquidity, balance sheet, how are they looking?
They emphasize they have robust liquidity and a strong balance sheet. Which, is always good, but especially important in today's more volatile market.
Definitely. And how are they thinking about using their cash? What are the priorities for capital deployment?
Pretty clear priorities. 1, invest in their own systems, water, wastewater, land development, infrastructure.
Makes sense. Feed the beast.
2, look for opportunities to acquire more water rights. Always valuable.
Right.
And 3, potentially pursue other land acquisition opportunities if the right deals come along.
What about share buybacks? Did they mention those?
They did. Share repurchases were lighter in Q3.
Oh.
And that was apparently a conscious decision to conserve cash. They need that capital to deliver on their core business model, especially with those big filing 6 deliveries coming up in Q4.
Okay, so preserving cash for operations makes sense. Did the CEO talk about the broader housing market, any headwinds they're seeing?
Yeah, he touched on the usual suspects. Consumer confidence being a bit shaky. Mortgage rates, although interestingly, he said rates were maybe less of a headwind now than they have been historically, which is sort of counterintuitive.
Huh. Okay.
Affordability is still a big issue, obviously, and rising inventory levels as the market slows down a bit.
So standard housing market concerns. How does PureCycle feel they're positioned against those headwinds?
Well, this is where their unique model really comes into play. They feel they have several advantages.
Like what?
First, Sky Ranch is positioned as an entry-level master plan community. That segment tends to hold up better in downturns.
Okay.
Second, their role as the horizontal developer gives them more control and flexibility than just a home builder. Third, the Denver market, specifically for entry-level homes, still has very low inventory. Demand remains strong for what they offer.
So anemic supply helps them.
Definitely. And fourth, that just-in-time lot delivery model lets them adjust production based on real-time demand from builders. They aren't likely to build a ton of excess inventory.
They also mentioned a bit of a slowdown in the vertical construction, the actual home building in Phase 2B. Was that just the market or something else?
Sounded like a bit of both. Partly the general market slowdown, but also tied back to those builder delays and adapting to the new building permit processes we talked about earlier.
Ah, those permitting issues again.
Yeah.
So it wasn't necessarily that PureCycle couldn't deliver the lots.
Well, it doesn't seem like it. More about the builder's pace on the vertical side.
So bringing it back to the market reaction, that shrug, that modest dip, it sounds like investors may be focused too much on the slight year-over-year revenue dip caused by timing.
Now, that seems plausible. You know, overlooking the strong margins, the reaffirmed guidance, the mineral income cushion, and focusing on that headline revenue number being down year over year because of the filing 6 timing.
Which reinforces the idea it was seen as company-specific, not a red flag about their core business.
I think so. Which leads us to that whole idea of hidden value or stored value.
Right. The value locked up in those water and land assets that have appreciated over time.
Exactly. And their flexible model allows them to navigate cycles like the ups and downs in demand from industrial water users, while that core asset value keeps growing.
They also briefly mentioned ongoing work on Box Elder Creek water rights and long-term plans for reservoir sites.
Yeah, just underscoring that they're continuously working to enhance, monetize, and expand those core water assets. It's a long game they're playing.
So thinking about all this, what really stands out to you about how PureCycle can kind of flex and adapt, given that huge long-term asset base? How different is that?
It's fundamentally different. Most developers are purely transactional, focused on near-term lot sales. PureCycle has this massive appreciating asset base, primarily the water, that gives them incredible staying power and options. They can throttle land development up or down based on the market. They can lean on mineral income. They can wait for industrial water demand to return, all while the intrinsic value of their water rights likely continues to increase. That flexibility combined with the scale of the underlying assets is, well, it's why you call them a unicorn.
Okay, well, that brings us to our segment we like to call Not Financial Advice.
Right. Just a thought experiment, an idea to kick around. Definitely not investment advice. Do your own research. Talk to a professional.
Absolutely. So what's the outrageous but plausible trade idea for PureCycle this time?
Okay, how about this? The water and land unicorn, long shot.
Intriguing name.
The idea is a multi-year long position in PCYO, maybe using deep in the money call options to get leverage.
Okay.
And you pair that with a strategic short position on a broad homebuilder ETF like XHB or ITB.
So long PureCycle, short the home builders. What's the thesis?
The thesis is the market is obsessed with the short-term noise, quarterly lot sales, housing cycle ups and downs. It's completely missing, or at least drastically undervaluing, PureCycle's core assets. Those scarce Colorado water rights worth potentially billions in future tap fees, and their unique, flexible position as a horizontal developer.
So the trade is betting on that value eventually being recognized.
Exactly. You're aiming to capture the multiple expansion when the market finally wakes up to that stored value, especially as Sky Ranch builds out and maybe a Lowry Ranch service comes online. The short on the home builder ETF is basically a hedge.
A hedge against what?
Against broader housing market weakness or volatility. If the whole housing sector takes a hit, the short position helps offset potential declines in PCYO that might happen just due to market sentiment, even if Pure Cycle's own fundamentals remain strong. It isolates the Pure Cycle-specific long-term value proposition.
Interesting. Long the unique asset play, short the cyclical commodity builders definitely fits the outrageous but plausible bill.
It's a bet on scarcity and unique positioning versus the broader cycle.
Okay, let's wrap up this deep dive then. Key takeaways from Pure Cycle's Q3 Fiscal 25 call.
Well, yes, there was a slight miss on the headline revenue and EPS numbers.
Right, with the timing issue.
Exactly. But underneath that, you saw really robust gross margins, significant cushioning from mineral income, and importantly, a reaffirmation of their full-year guidance.
And they've got strong liquidity, a solid balance sheet, and a business model that seems exceptionally well-suited to navigating the current housing market. That flexibility is key.
Absolutely. And the real story, the long-term story, remains intact. It's all about those strategically located, highly valuable water and land assets. That's where the significant future monetization potential lies, far beyond any single quarter's results.
So here's a final thought to leave you with. Denver keeps expanding eastward. Water in the West is only getting more critical, more valuable. How might Pure Cycle's very patient, long-term cultivation of these, hidden value assets reshape how the market values this company in the years ahead?
Something to think about.
Definitely. We'd love to hear your thoughts on this deep dive.